Hello and welcome back, guys. So in this particular session what we will be discussing about is Zoe. Okay, so in this particular session, what is Zoe? So it's a SPR's exam kit. Okay, so what we are given is that, as you can see within your screen, Zoe, a public limited company, operates in a media sector. Zoe has investment in number of companies. The draft consolidated statement of financial position at 30th November 20x4 is as follows: PP 6709, goodwill 40, investment in associate which is Margie 700, current assets 2011, total assets 7460, share capital 850, retained earning 4086, other component of equity 258, right? Non-controlling interest 908. All these things are given. Okay, so let's see the requirement first of all. So explain with suitable workings how to correct the errors that have arisen when accounting for the acquisition of Hulti. So the adjusting entries required to correct the consolidated statements of financial position, right? So let's do it. Just give me a second. I'll just turn this thing up. Okay, so we are required to correct the entries that have been mistakenly uh, entered. Okay, so in case of Hulti, what has happened is on December 20x3, right? So that means exactly 1 year ago. So 30th November 20x3 would have been the opening year, right? Opening time. So that means exactly 1 year ago, Zoe acquired 80% of the Hulti's $600 million $1 equity shares in exchange for cash of 750. The carrying amount of Hulti's net assets at the acquisition date was 960. So he determined that the fair value of the non-controlling interest, 20% non-controlling interest in Hulti at the date was 250 million. It was group policy to measure the non-controlling interest at fair value, so he recorded a goodwill assets arising on acquisition of Hulti of 40 million. What they did was 750 plus 250, 1000 minus 960, right? So there is furthermore to it. So however, shortly after the acquisition date, the accountant of Joey realized that the following deferred cash consideration of 50 million arising on the acquisition of Hulti had not been recorded by Zoe. The payment is due on 30th November 20x5. An appropriate discount rate is 10%, right? Okay. So 20x5, 30th November 20x5. So currently we are in 30th November 20x2, isn't it? We are in 20x4. Okay. So that means how much should we discount it by? So 20x3 it was acquired, so it is payable on 30th November 20x5. That means 30th November 20x3, and then 30th November 20x4, and then 30th November 20x5, right? That means 2 years. And discount rate is 10%. Okay. So the fair value of Alti's net identity value was calculated to be 980, so 20 million above, right? Excess in fair value of the net assets over the carrying amount was due to an unrecognized franchise right with a remaining useful life of 4 years, so that should be amortized. No entries have been recorded in respect to franchise. Okay, let's do it. So what's the number? Question number A first, right? A1. Come on, man. Is Hulti, right? Okay. As per IFRS 3 business combination Goodwill is calculated by as the difference between cost of investment and NCI and fair value of net assets. Fair value of net assets, right? Now the cost of investment should incorporate cost of investment should also incorporate all kind of consideration. Transferred to achieve control over another business. This is about deferred consideration, right? Consideration. Okay. The deferred consideration of 50 million. Is that 50? 50 million is due on that date. Discount rate is 10%. 50 million deferred consideration of 50 million payable at 30 November 20x5 has a present value of dollar. It's calculated. Okay, so for consideration, right? So to be paid, present value of consideration, right? So it's 50 million, right? So that means 50 divided by 1.1 to the power 2, because it is, we need to bring it back 2 years. So it has a present value of 41.3 million. At 1st December 20x3, right? Since goodwill does not include this figure, since in case of Alti, while calculating calculating goodwill deferred consideration was not taken into account, so goodwill will increase by this amount, and the correcting entry will be so we need to debit goodwill by 41.3 million, and then credit liability. This will be under NCA, non-current liabilities. Okay. Yep, it will be under. I don't know when are we preparing our consolidated financial statement. We need to look at that as well. So we are preparing it at 30th November 20x4, right? So we are paying them within 1 year, I guess. We are paying them within 1 year. Yes, so it can be classified as current assets. Okay. 1.3 million. Okay, so once that's done, so what will happen is this amount will increase by the year end by the finance cost. So it is as below. Of how much million? Let's see. I think it will be this figure into 10%, right? Or 0.1, so 4.13. What will be the final amount? This figure plus this figure, right? 4.1, right? Will increase by $4.1 million. So the correcting entry will be debit retained earning. So our profit will go down, right? 4.1. So since the profit has already been calculated, so this will be liability, and then this will be the amount that it has basically increased by liability. Okay, so this is $4.1 million, 1 million, something above as well. So once this has been settled, so after that, what do we need to for the case of net assets, right? So let's do it for net assets as well. So net assets. Calculation of net assets. At acquisition at reporting, right? So what was the net assets? total figure was 960, and then 960, but the fair value as at 1st December 20 had been calculated to 980. The excess in fair value was due to that, right? So that means 980. Uh, that means this figure will be 980 minus 960. So this is fair value adjustment, right? Adjustment for franchise excess amortization, since it has a limited life, so we need to amortize it as well, right? So what was the net assets at closing period? Is it not given over here? So where does it say? The carrying amount was over the fair value and was due to unrecognized franchise with the remaining useful life of 4 years as at 30th December 20x3, right? So by 1 year depreciation has gone by, okay? So we don't need to worry about that. Just put in this value, divide by 4 into 1, since only 1 year has gone by, right? Okay. What we will need to do is that this figure will basically, so how much is our cost of investment now? It is calculation of, let's do calculation of goodwill, okay? Calculation of goodwill. Don't worry about that at reporting periods figure. Calculation. What figures do we have over here? Zoe, a public limited company. Okay, so that was the acquisition of thingy. So we don't have that cost of investment, right? Investment is divided into two, cash and deferred consideration. Right, so cash being, how much was the cash? Cash, 750, right? 750. And then this figure is present value of consideration is this, and then after that non-controlling interest. Fair value of NCI is 50. So our total will be, come on man, less net assets at acquisition. This being this figure 980. So this figure minus this figure 61.322 should be our goodwill, right? So since our goodwill has already been recorded by how much? As per the company, how much they have recorded it? They have recorded it 40, right? So it should be 61 point earlier recorded, so 40, right? 40, and then what has it increased by? Consideration, deferred consideration. Is it 40 though? It's 1000 minus 1000 minus 160, right? Yep. Okay, so yeah, goodwill has increased by this amount, right? And so, and then will also decrease by few amount, okay? And so fair value adjustment will decrease it. minus 20 should decrease it. Okay, so let's have a look at this first of all. So let's write it down. Net assets, not net assets, is it is about intangible asset, right? So it's about franchise right, franchise right, franchise right, right. Okay, so what has basically happened is that the fair value has been gone up, right? IFRS 3 business combination says that the net assets should be valued at fair value during acquisition. Acquisition, right? So okay, so what has happened is, let's see our financial statement. Okay, is there any intangible assets? No, it has not recorded any intangible assets. Okay, let's do that. In case of Hulp, assets, net assets, fair value of net assets net assets has increased by $20 million, which is basically $980 minus $960. $960, right? And this is because of the unrecognized intangible assets, that is franchise right, which had not been recognized earlier. So a correcting entry is required. Debit intangible assets. $20 million credit goodwill, right? So what has happened is that, basically, see this figure, otherwise it normally should have been 980. So what that has done is that, since that figure has increased, so it has decreased our goodwill, right? So suppose if this was 960, see how that figure will jump. That 61 will be 81, right? So since it has increased, that means what will happen is that our goodwill will be credited, right? So that's all I'm doing over here. Okay, so see, that's the goodwill I got. Okay, so it always should match. It's always good to check as well at the side. Okay, so earlier they had recorded a goodwill of 40. Goodwill has increased by this amount that has been changed, right? They had not recognized it. And then as well as for the intangible assets as well, it has not been recognized. That's why it will change by that amount. Okay, anything else? Anything else? Yes, there is something else. So there will be excess amortization thing as well, right? So since it is a subsidiary, this will be divided into two. So this figure should be divided into two. So that means 50 into 0.8, and then another will be for NCI. This minus this. NCI parent, right? So IAS 38 intangible assets is any assets without physical, the non-financial asset, then non-financial asset, non-financial asset, financial asset without physical form, right? They are uh, recognized if they meet the definition and recognition criteria of an asset and are usually of two types. Two type, usually of two type, right? Uh, Definite life and indefinite life. Definite life is amortized as per its lifespan using straight line basis over its useful life. Definite life is amortized over useful life, similar to depreciation, whereas indefinite is only checked for annual impairment. Impairment annually. In case of Alti, is an asset with indefinite life, which will be amortized every year by $5 million, which is basically $20 million divided by 5, right? And since this is a subsidiary, so the excess amortization charge is beared by both the parent and subsidiary based upon its holding percentage. Entry will be debit retained earning, debit NCI, and then after that credit intangible assets, right? By $5 million. This is $1 million. This is $4 million, right? 4 million. Okay, so I've just divided it according to their thingy. Otherwise, normally what would happen is that if there was a figure of 1000, what we normally used to do is that we used to basically subtract 1000 minus 980, and then we used to allocate it that way. But in this case, we don't have the total net assets figure, so we don't need to calculate fair value, NCI as well. So it's already been calculated, so we have to deduct from it. Okay, that's pretty much it that we need to do in case of number A. Okay, so what's our total goodwill? Total goodwill will be 61.3, right? Therefore, carrying amount of goodwill in the statement of financial position will be $61.3 million. Okay, so once that's done, let's move on to question number B. No, not question number 2. Just bold it as well. So what is question number 2 about? It is about Margie, right? So what are we required? So explain with suitable workings how to correct the errors that have arisen when accounting for acquisition of Margie. So the adjusting entries required to correct the consolidated statements of financial position. Okay, we will do that. So Margie is associate, right? Okay. Margie. It's bolded as well. What has been the issue? Let's look. So on 1st December 20x4, that means exactly 3 years ago. Yep, exactly 3 years ago, right? So Zoe acquired 30% of ordinary shares of Margie for a cash consideration of 600 million. Okay, so what has been the figure that they have reported in SOFP? 700. Okay, that must have been adjusted for, should have been adjusted for dividends and share of profit as well, I guess. So let's see. So Zoe treated Margie as associate and as equity accounted for Margie up to 1st December 20x3. The investment in Zoe as at 1st December 20x3 is still included in draft consolidated financial statement of financial position at 31st December 20x3. The fair value of the 30% interest was 705 million. Okay. On 1st December 20x3. So that means after exactly 2 years, right? Acquired further 40% of the ordinary shares of Margie for a cash consideration of 975 million and gain a control of the company at 1st December 20x3. The fair value of the Margie's net identifiable assets was 2250. The fair value of the non-current assets, non-controlling interest was 620. The gain of bargain purchase of 655 million had been recorded. Okay. So what do we need to do is that our fair value is 1705, right? Okay. So cash consideration 975. So let's go to our Excel sheet again. Cash consideration 975. So we don't have any default consideration over here. There is something else. There is something else. There is fair value of earlier interest is 705, right? 705 is there. So any gains or losses on that will be charged to SOPL, right? 620 NCI, 620. 620. Okay, what about net assets? What has happened? 2250. 2250. Okay, 2250. 50. What has been the fair value adjustment? The building with carrying amount of 200 million has been included in the fair value of Margie. Okay, that has been included. The file has been useful life of 20 years. However, Zoe had commissioned an independent valuation of the buildings, which was not complete at 1st December 20x3, therefore was not considered in the fair value of the net assets at acquisition date. The valuations were received on 1st April 20x4, which resulted in a decrease, okay, of 40 million in the fair value of PPE at the date of acquisition. The fair value and decrease, which does not reflect the fair value of the non-controlling interest, had not been entered into financial statements of Margie for the draft financial statement. Building are depreciated on a straight line basis. Okay, so its value has decreased to that figure. The fair value decrease, which does not affect the fair value of the non-controlling interest at acquisition, which has not been entered into financial statement. Okay, good. And that means so it has gone down by So what I'll do is I'll just move this a bit down, then let's look at it properly. So it has gone down by 60, right? Isn't that what the question says? Decrease of 40. Minus 40, right? So which is already included within this figure. That means the figure was this minus 200. 2050 was our thingy. plus 160. $200 is decreased and that's gone down, right? So that means this figure will be over here. Okay, and then after that, what will happen is that which was included within this figure, right? 2250. So that means 200 million will be removed from it first of all. So that means it will only be plus this figure, right? 2210 from 1 million sum 2250 minus 40, right? So anything else? Anything else in the building? Okay, so what has been the excess or excess depreciation understated depreciation? So what has basically happened is that it was 200, right? Should have been 160. So remaining useful life at that period. So 1st December, right? So 1st December, okay. So independent valuation 20 years, okay. So 20 divided by 10, right? Okay, so it should have been only 8, but it has gone up by 10, right? So that means this minus this. 2 is the excess depreciation that has been charged, right? So PPE will be credited by 2 million, right? I mean debited by 2 million, and then that will be given to both of them based upon their holding percentage. So 2 will be distributed among parent and NCI. So how much is that? 70 and 30, right? Okay, so 70 and 30. 2 into 0 0.7. 2 into 0 0.7 minus this parent NCI, right? And then after that, what else do we need to worry about? Anything else? I don't think so. So our goodwill will be 2210. Okay, so what we will do is that let's talk about investment only. Okay, so what we will do is that so this is step acquisition, right? So it is step acquisition since Zoe has taken control in stages. So on the date control is taken, the earlier held interest is revalued to fair value, right? Fair value and any gain or losses. Any gain or losses is any gain or losses is accounted for, is charged to SOPL. In case of Margie, the earlier held interest has gone up by $5 million. Isn't it 5 million? 705, right? 705. Yep. So what was over here? 700 has gone by up by, and this figure. So which will be 705 minus million minus dollars, 700 million, right? So what has happened is that, so goodwill was 90, right? So what they have done is that, what did they do? So what mistake did they do? They calculated a goodwill of thingy, this figure, 655. Okay. And the bargain purchase gain should be removed from the retained earning of how much? Dollars 650 million? 650, I guess. 655, right? So 655 should be removed from retained earning. So what will be the entry basically is that debit retained earning $655 million, and then after that what else do we need to remove? What has happened with the revaluation is it has gone down, right? So that means our revaluation surplus will also go down. Or what will happen is that, so we will remove this, and then after that we will also write goodwill. How much will we record goodwill for? 90 million. What is the goodwill? So what we will do is that we will basically include a goodwill figure of, so let's explain it over here. Better to explain. Goodwill will increase by 655, right? So how much was the earlier held interest? So goodwill will increase by the equity accounted investment in Margie of $700 million should therefore have been eliminated and included should be included where should it be included while calculating, included in goodwill calculation at fair value of $705 million, right? I've already talked about that. Come on, boys. That's already gone up. So in this case, what will happen is that the goodwill will go up by 655 minus 705. Okay. So this will be, isn't it? So where has the changes happened? So how did this 90 become 90? What would have been this figure earlier on? Earlier on it was, when they were calculating it, how much was it? 975 plus 620, right? 975 plus 620. Okay. So they had just added this figure plus this figure, right? So 1595. They had added it up. And then how much was over here? Was this figure 2250, right? So this change is attributed to, this change over here is from here, and then after that there should be a 50 gain over here, okay, to reach that figure. So what they did was, basically, this is same, right? This is basically same as well. Why they reached this figure, and then what they did was this figure minus this figure. Okay. So what we can do is that this figure minus this figure should give us 50. Okay, so what they did was, they only suppose this was 655, that's why it should give us 50. Yep, that's it, and that's how we get a goodwill of 90. Okay, so our goodwill over here will be 50 million. And then what else is there? What else is there? What else has happened? So basically there has been a investment in associate has been changed. We need to credit that figure as well, right? Because we need to remove it from there. Credit investment in associate. Investment in associate of $705 million, and then remaining will be charged against retained earning, which is basically the gain on thingy. Okay, so how much will this figure be? So 655 plus 50, 655 plus 50, 655 plus 50 will be 705. 705, that means nope, because investment is only 700. Then return earning will be 5 million. This is basically gain on revaluation. Okay, so in case of what did we actually revalue was in downward valuation of building, right? Building. Let's create a separate heading for this. Okay, so when we are creating a separate heading for building, what we need to be aware is that we need to let's say give a bit of definition from IS 16 as well, or what shall we say in case of building, right? So it has been downward value revaluated. So what we should talk about is let's say as per IFRS 3 business combination, assets are valued at fair value during acquisition, and if the value can't be determined at this point in time, but the acquirer becomes aware on a later date, they have to just retrospectively. Thus, this will affect goodwill too. In this case, the value of, let's not say, let's say the revision of the building's fair value at the acquisition, it was determined within 12 months of the business combination. So it must be adjusted the acquisition date. Okay. This will reduce the amount of plant and equipment in the consolidated statement of financial position, right? So what do we need to do is that and will also increase goodwill on acquisition of Margie. Isn't that the company that we are acquiring? Yep. The adjusting entry will be, so what will happen is that the building's value will go down, right? So what will happen because of that? Goodwill will go up by how much? 40 million, since we will be paying more for that particular asset, right? I mean, because the value of net assets has gone down, so our goodwill will increase definitely. So PE will be, PE will also be changed by same amount, $40 million. Right, after that, the property, plant and equipment has been included in the consolidated statement of SOFP at $200 million rather than 100 million, which should be corrected to $160 million. This will also affect the depreciation, which will be basically how much? $2 million. 40 million divided by 20, right? Divided by 20. Depreciation of 2 million as it has been it should have been depreciation by 2 million. It should have been how much? How much it should have been? 8, right? It should have been 8. No, it's 10. It should have been 8. It should have been 8 million only. This should be removed from SOPL or is credited to retained earning since this is a subsidiary which has an interest in the profit, so it should also be allocated to controlling interest based upon their respective shareholdings. Entry will be debit. What will happen? PP will increase, right? PP will increase by 2 million. Credit retained earning. Credit NCI 0.4 and 1.6, isn't it? 1.4 and 0.6. Okay. 4 and 0.6. 0.6. Therefore, carrying amount goodwill in consolidated statement of financial position should be $90 million. Right, that's pretty much it for this, I guess. Anything else that we are missing? Discuss with suitable calculation how the agreement with CP should have been accounted for in consolidated financial statement. Marks 6 marks, right? Okay. So what have we done with CP? Okay. So Zoe is looking to expand into publishing and entered into an arrangement with Content Publishing CP, a public limited company, on 1st December 20x3. CP will provide content for a range of books and online publications. CP is entitled to royalty as 10% of sales and 30% of gross profit of the publications. Zoe has sole responsibility for all printing, bidding and binding and platform maintenance of the online website. The agreement states that key strategic sales and marketing decisions should be agreed jointly. Zoe selects the content to be covered in the publications, but CP has right to veto over this content. However, on 1st June 20x4 on Meteor, Zoe and CP decided to set up a separate legal entity. Okay, so it was just joint operations before, so now it will be JV. So separate with equal shares and voting rights. CP continues to contribute content into JCP, but does not receive royalties. Zoe continues the printing, bidding, maintenance, sales, and where this respectively. The whole of the sale proceeds and the cost of sales were recorded in Zoe's financial statement with no accounting entries being made for JCB or amounts due to CP. Zoe currently funds the operation. Assume that the sales and cost occur evenly throughout the year, that all the transactions to the JCB should have been in cash. That means 5. So after this, what has happened is that after this period, so on 1st December 20x3, right? At the beginning, and then after media, they formed a separate entity. After that, it will be equal shares. Okay, so that means after that, it will be 50-50. So let's discuss about it. 3 number, right? Control B. So first of all, what we will do is that joint arrangement. It's basically joint arrangement anyway. Arrangement, right? So during the first few period, what had happened was that it was not a separate entity, right? So for the period till, how much is it for the period until May 31st May 20x4, 31st May 20x4, the requirement for unanimous key strategic decisions means this is a joint arrangement. Arrangement, since there is no legal entity, it would be classified as a joint operation. Zoe should therefore count for the direct rights to the underlying assets, right? And then after that, what they should do is that basically so revenue is dollar, how much? 5 million, right? So December, January, February, March, April, May, 6 months. Okay, good. So 6 divided by 12, right? So 5 into 6 divided by 12, this will be $2.5. dollar 2.5, right? And then COS is 2 million, right? Dollar 2 million. 2 into 6 divided by 12, same thing as that. Dollar 1. So gross profit will be 1.5 million, right? So out of this, how much is attributed to CP? CP is entitled to royalty, calculated as 10% and 30% of that, right? Okay, good. That means how much should we pay to CP? The amount among this, the amount to be paid to CP is calculated below, right? Sales 10% into 2.5, which will be 0.25 million, right? Gross profit 30%, 30% into 1.5 million, 30 into 1.5, 30 into 1.5, 0.45, no, 0.45 million, right? So how much will be total payable will be dollar 0.7 million, right? So this amount will be payable to CP, right? Since Zoe has, does it say it has not recorded? I guess it says that, right? Covered in thing, no accounting entries. Since the whole sales and cost of sales has been recorded by Zoe, but no entries have been made in regards to CP share, so payable should be created for CP. Entry will be CP, right? Entry will be debit SOPL dollar 0.7 million, credit payables, right? Dollar 0.7 million. So from that period to 6 months, right? So after 6 months, hold it again. from 1st June 20x6, Zoe has a share of net assets, and a new entity has been registered, so it is classified as joint venture. So as per IS 28, it should be equity accounted. Right? So in this case, what we need to figure out is that Zoe has accounted for all the proceeds and costs of the joint venture. This should be removed from statement of profit or loss, and a payable should be recorded. So a payable should be recorded, right? So how much should the payable be recorded by? Payable to transfer it back to new entity JCP, right? So how much will they debit it? So PL, they will basically do 1.5 million, right? So 1.5 million, and then payable to JCP $1.5 million. 0.5 million, right? After that, Joey should then equity account for its share of JCP's profit of dollar half of 1.5, right? 0.75, 50% of 1.5. This will be recorded as share of profit. It's already cash, right? Isn't that what it says? So we at the end, all the transaction related to JCB has been in cash. We'll record this will be recorded in statement of profit or loss and recognized as an investment in associate not associate, why am I saying if it has an investment in the statement of financial position. Shell position, right? Once that's done as well, so let's do the entry. So investment in JB $0.75 million, and then after that credit SOPL $0.75 million, right? So this is how it will be entered into. That's pretty much it, I guess. What else do we need to do with suitable workings? How the agreement should be accounted. Okay, so we need to move on to question number B. Okay, so there will be two parts to B as well. So since it has already been so long, so what I will do is that I'll make a separate part for that B. So write it down as well, B1, right? So what is it about? It's about, I guess, so equity or liability. Okay, so yeah, we'll talk about that in next part. Okay, so if you've got any other questions until now or till over here, please do comment down below. I'll definitely answer it for you. So I'll see you in the next part. Okay, thank you, bye bye.